During the early and mid-1920s, the United States entered an unprecedented era of rapid industrial expansion and economic optimism. The American stock market became a national obsession, with daily trading volumes reaching heights that had never been seen before. Ordinary citizens, from factory workers to middle-class teachers, invested their entire life savings into corporate shares with the hope of quick wealth. Much of this speculative frenzy was fueled by the dangerous practice of buying on margin, where investors borrowed up to 90% of the stock's price. While Wall Street celebrated, structural weaknesses were beginning to build underneath the surface of the glowing consumer economy. American factories were producing goods far faster than wages were rising, creating a severe problem of systemic overproduction. At the exact same time, the nation's agricultural sector was suffering from falling crop prices and heavy farm debt. On Thursday, October 24, 1929, the fragile financial card house finally began to collapse. This day, which became known as Black Thursday, triggered a massive wave of panic selling that overwhelmed the exchange floor. Major bankers attempted to stabilize the market by buying large blocks of blue-chip stocks, but their efforts failed to stop the slide. The panic reached its absolute climax on Black Tuesday, October 29th, when 16 million shares were dumped in a single day. Billions of dollars of speculative wealth vanished into thin air, leaving investors with huge debts and worthless stock certificates. The Wall Street crash was not just a paper crisis. It immediately began to paralyze the nation's banking system. Banks that had invested their depositors' money directly into the stock market faced sudden and devastating insolvency. Fearing that their local institutions would run out of cash, crowds of anxious depositors rushed to withdraw their savings. These banking panics, or bank runs, became a self-fulfilling prophecy that forced thousands of banks to close their doors forever. Because there was no government deposit insurance at the time, depositors in failed banks lost every single dollar they had saved. By 1933, more than 9,000 banks had collapsed, wiping out billions of dollars in personal savings. The sudden destruction of the banking system caused a severe credit contraction, making it impossible for businesses to secure loans. Without access to working capital, companies could no longer purchase raw materials, pay their utility bills, or meet payroll. Businesses across every major industry began to cut costs rapidly by laying off millions of employees. The national unemployment rate climbed from just 3% in 1929 to a staggering 25% in 1933. In major industrial cities like Chicago and Detroit, the local unemployment rate exceeded 50% of the workforce. Millions of workers who had spent their lives building the nation were left without any source of income or support. Homeless families migrated to the edges of cities, building crude shantytowns made of cardboard, scrap wood, and sheet metal. These miserable settlements were named Hoovervilles, a bitter reference to President Herbert Hoover's perceived inaction. In every major city, thousands of hungry people queued in bread lines and soup kitchens for hours just to survive the day. The agricultural heartland of America was simultaneously struck by a double catastrophe of economic ruin and ecological disaster. As crop prices dropped below the cost of harvesting, farmers could not pay their land taxes or bank mortgages. Family farms that had been cultivated for generations were foreclosed by banks, forcing families onto the roads. Then, a historic drought struck the southern Great Plains, turning millions of acres of fertile soil into dry powder. Intense winds created massive, black dust storms that swept across the landscape, giving the region the name of the Dust Bowl. The dust storms suffocated livestock, destroyed machinery, and made normal agriculture completely impossible for several years. More than 2.5 million people abandoned the plains, migrating west toward California in search of farm work. The economic crisis did not remain within American borders. It rapidly spread across the globe through international trade. American banks, desperate for liquidity, began to recall the short-term loans they had made to European nations after the war. Germany, already burdened by massive war reparations and high inflation, saw its industrial production cut in half. Global trade declined by 66% as nations passed protectionist tariffs. The Smoot-Hawley Tariff Act of 1930 worsened the global crisis. Governments attempted to protect domestic industries, but ended up killing international trade. The global trading system was effectively strangled as protectionist policies turned a domestic downturn into a worldwide depression. The gold standard acted as a golden fetter, preventing central banks from expanding the money supply to combat deflation. Under the rules of the gold standard, nations had to back their paper currency with physical gold reserves. If a central bank printed more money, investors would lose confidence and redeem their paper currency for gold. To prevent gold from leaving the country, the Federal Reserve decided to raise interest rates instead of lowering them. This contractionary monetary policy reduced the money supply by 1/3, severely worsening the ongoing deflationary spiral. Prices for goods, services, and wages fell rapidly, making the real burden of existing debts heavier for everyone. Businesses that could have survived under normal conditions were forced into bankruptcy by the falling price levels. Economists have debated the root causes of the Great Depression for nearly a century, offering different theories. John Maynard Keynes published his landmark general theory, arguing that the crisis was caused by a collapse in aggregate demand. Keynes asserted that during a deep depression, private spending drops so low that the economy cannot heal itself. He advocated for government spending to stimulate the economy and create jobs. In contrast, monetarist economists led by Milton Friedman blamed the crisis on the monetary policy of the Federal Reserve. Friedman argued that if the Federal Reserve had acted to provide liquidity to banks, the money supply would not have collapsed. The human cost of these theoretical debates was felt by millions of families who lost their livelihood. The psychological impact of the Depression was deep, creating a lifetime of caution and frugality for those who survived it. People who lived through the 1930s carried a permanent distrust of banks and financial markets for the rest of their lives. In the presidential election of 1932, voters overwhelmingly rejected Herbert Hoover's conservative approach. Franklin Delano Roosevelt was elected in a landslide victory, promising a New Deal for the American people. Roosevelt immediately declared a national bank holiday, closing all banks to stop the panic of runs. During this holiday, Congress passed the Emergency Banking Act, allowing only solvent banks to reopen under government supervision. Roosevelt began his famous fireside chats, speaking directly to millions of Americans over the radio to restore confidence. The New Deal introduced a massive wave of government intervention, forever changing the relationship between citizens and the state. The government created the Federal Deposit Insurance Corporation, guaranteeing that bank deposits would be protected by the state. They established the Securities and Exchange Commission to regulate the stock market and prevent speculative manipulation. To provide jobs, the government launched massive public works programs like the Works Progress Administration and the Civilian Conservation Corps. Millions of young men were hired to build roads, bridges, state parks, and planting windbreaks to fight soil erosion. The Tennessee Valley Authority built a series of dams, bringing electricity and flood control to one of the poorest regions. The New Deal also established the Social Security system, providing old age pensions and unemployment insurance for workers. Despite these radical reforms, the New Deal did not succeed in fully ending the Great Depression. The economy experienced a partial recovery, but fell back into a sharp recession in 1937. Unemployment remained above 15% throughout the 1930s, showing the persistent nature of the crisis. It was ultimately the outbreak of the Second World War that brought the Depression to a final end. The massive mobilization of resources for the war effort forced the government to spend on an unprecedented scale. Factories began operating 24 hours a day to produce tanks, airplanes, ships, and weapons for the military. Millions of unemployed men were drafted into the armed forces, while millions of women entered the industrial workforce. The war created absolute full employment, finally restoring the nation's industrial output and ending the long crisis. The legacy of the Great Depression completely redefined the field of macroeconomics and government policy. The laissez-faire belief that free markets would always self-correct was replaced by active government management. Central banks assumed the responsibility of managing the economic cycle through interest rates and money creation. The gold standard was permanently abandoned by most nations, allowing currencies to float freely against each other. Modern central banking is built entirely on the fear of repeating the deflationary collapse of the 1930s. When the global financial system faced collapse in 2008, central banks acted with unprecedented speed. They flooded the banking system with liquidity, buying up bad assets and dropping interest rates to zero. They printed trillions of dollars through quantitative easing, determined to prevent a contraction of the money supply. While these policies prevented a second Great Depression, they created a new set of long-term economic risks. The constant creation of new currency has led to severe inflation and the devaluation of purchasing power. The total debt in the global financial system has reached levels that can never be realistically paid back. For modern investors, the lessons of the Great Depression are highly relevant for preserving wealth. We live in a system that is highly leveraged and dependent on continuous central bank intervention. If the flow of new credit slows down, the entire financial card house faces another severe liquidity crisis. To protect your hard-earned capital, you must understand the difference between paper wealth and real assets. During a credit collapse, paper assets like stocks, bonds, and bank deposits can lose value overnight. Holding a portion of your wealth in tangible assets like gold, silver, and productive land is a crucial shield. These real assets cannot be printed, devalued, or wiped out by a banking system failure. Diversifying your portfolio across different asset classes is the best way to survive economic instability. You should avoid excessive debt and leverage, which make you highly vulnerable during a downturn. Maintaining cash reserves outside of the traditional banking system provides flexibility during emergencies. The banking system is only as stable as the government's ability to print money to back it. If the currency itself loses value through hyperinflation, bank deposits lose their real purchasing power. Educating yourself on monetary history allows you to recognize the warning signs of market bubbles. When speculation reaches extreme levels, as it did in 1929, a crash is inevitable. The pattern of boom, bubble, crash, and intervention has repeated many times throughout history. The Federal Reserve's balance sheet has expanded to historic size, showing the fragility of the recovery. Investors who assume the government can prevent all market cycles are taking a massive risk. A resilient portfolio must be designed to withstand both high inflation and deflationary periods. Gold has served as the ultimate store of value for thousands of years because it cannot be created by decree. Commodities like oil, energy assets, and agricultural land have real utility that maintains value. Focus your investment strategy on cash flow and actual utility rather than capital gains. Real wealth is built on the production of goods and services that people need to survive daily. Keep your financial plans simple, cautious, and aligned with historical macroeconomic realities. The geopolitics of global currency are shifting as the dominant role of the dollar is challenged. If the petrodollar system declines, the United States will face a major loss of monetary privilege. This could lead to a severe domestic economic adjustment and higher interest rates for decades. Those who study the lessons of 1929 will be best prepared for these shifts. Do not let market optimism blind you to the growing structural debts of our system. Maintain a healthy skepticism toward the promises of financial institutions and central planners. Your financial security is ultimately your own responsibility, not the state's responsibility. Build your resilience by acquiring hard assets, eliminating debt, and learning history. In the next years, the global monetary system will continue to evolve under high debt pressure. The transition to new currency systems will create volatility and opportunity for prepared investors. Those who hold hard assets will preserve their purchasing power through the transition. The rules of global finance are written by those who control the energy and the resources. Keep your wealth aligned with the physical realities of energy, food, and manufacturing. Avoid speculative investments that rely on constant credit expansion to maintain their value. The history of the Great Depression is a roadmap for navigating the crises of the future. By understanding how money dies, you can learn how to protect your family's future. Central banks will always choose inflation over deflation because inflation reduces the real value of debt. This means the long-term trend for all fiat currencies is a continuous loss of